My name is Michael Dino, and today we will discuss Common Stocks and Uncommon Profits by Philip Fisher. So before we discuss the most important parts of this book, let's have a brief introduction for the author. So the book was written in 1957. Even if the book is significantly dated, it still contains information that is relevant today. This is a testament of the effectiveness of the author. As you can see on the slide, he has experience as a security analyst, graduated from Stanford, and Warren Buffett considers him as a mentor. This shows the level of respect he has in the industry. So Philip Fisher gave 15 points to consider before buying a stock. For the sake of time, I chose 5 that, in my opinion, are the most important, especially for amateur investors. So for the first one, it talks about the importance of innovation. So we have to ask ourselves if the firm that we are thinking about investing in has an innovative culture. I think one of the obvious and overused examples would be Apple, but Apple has proved to be a smart investment indeed. I found it interesting how the book compares black and white TVs with the innovation of the color TV and hand crank phones with just normal hand telephones. This may seem humorous now, because the book is dated, but innovation should be continuous for a firm that wishes to stay competitive. For number 2, it talks about the abilities of the firm's sales force. This is, after all, the way a firm generates revenue, through selling. Fisher does point out in the book that it is the making of the sale that is the most basic single activity of the business. Essentially, if the firm is not capable of selling, then it will not be profitable and will not be in business for a long period of time. For number 3, it talks about the labor and personnel relationships. This may seem like it has nothing to do with the firm's financials, but it does have a lot to do with the long-term outlook of the company. If there's an abundance of negative information about the company concerning its labor relations, such as discrimination lawsuits or ethical problems, then this could be a sign that the firm will face challenges in the future. Number 4 talks about the short-term or long-term goals of the company. The difference here between the two goals is how they perceive they should earn their profits. Those that have a short-term goal may prefer to earn the highest level of profits right now, while those with a long-term goal tries to earn goodwill from stakeholders and earn profits on a longer time frame with the goals of making it sustainable. I think the longer time frame approach is a better option. I agree with Fisher's statement that the investor wanting maximum results should favor companies with a truly long-range outlook concerning profits. The fifth and final point is the integrity of management. These are companies, according to Fisher, that if there's a serious question of the lack of strong management's sense of trusteeship for stockholders, the investor should never seriously consider participating in such a business. I think the reasons for this is very obvious. However, as investors, we need to have a keen eye on detecting this. This is especially harder for smaller firms, which do not receive as much publicity as larger firms. So on this slide, we'll try to answer the question, when do we buy? So one of the very first points that Fisher mentions is that trying to forecast the future performance of a stock is like alchemy in ancient times. It is just not possible. It's almost like magic. But we do have to remember that this was written in the 1950s. The analytical tools and other forecasting methods that we currently enjoy were not even dreamed of during those times. To them it would be magic. So I think this point is somewhat questionable. What is not questionable is the point that what we buy is as important as when we buy it. Timing is important, but other factors come into play as well. We can talk about the profitability of the firm, the stability of the firm, and the sound financials of the firm. And according to Fisher, holding on to the right stocks long enough will always produce a profit. On this slide, we'll talk about when to sell and when not to sell. When we make mistakes, we have to be honest with ourselves and let go of behavioral finance. Earning high rates of return matters more than pride. And so when we make a mistake, we should be honest enough and sell. The other reason to sell is when a firm that was once profitable has exhausted all rooms for growth. Based on analysis, we should sell when a firm reaches this point. So when do we not sell? This next point is very interesting because of its absurdity and the truth in it. We should not sell if we get a positive gain because we expect that there will be a correction in the future that could erase that gain. An example is when an investor purchases an Apple stock for, let's say, $450. If that investor was irrational, then he would have sold it when it reached $500 or $550. However, if the investor held onto that stock, he could have received higher rates of return because right now the stock sells for $620 per share. We should not sell our stock because of fear. Instead, we should sell it based on our analysis. So buying low and selling high is traditionally the rule when we trade, but not always. We should not sell just because it's high. Instead, we should sell based on our analysis. The last point happens very often. Investors buy and sell way too much without careful analysis. Before we sell, in order to buy into a new firm, we should be sure why we're selling and what makes this new firm better than the one we currently own. If there is not a substantial difference, then there is no need to pay the fees associated with buying and selling. Don'ts for investors. So I think the points given on this slide are fairly straightforward. I would like to elaborate further on point number 2. Diversification is important, but there are dangers in over-diversification as well. The trap in over-diversifying is that we invest in firms that we know nothing about, just for the sake of diversification. This is actually more dangerous than not being as diversified. An example of over-diversification is when an investor has stock in 10 different firms which are all in 10 different industries. This may be more diversification that investor needs if he does not have an expertise on all the stocks that he has purchased. Finding a growth stock. This is perhaps the biggest goal of an investor. After all, it would be amazing to be an owner of a stock in the very beginning before its value starts to skyrocket. However, Philip Fisher does not suggest us to buy into IPOs. It is not necessarily the smartest thing according to him, because the true value of the stock is not reflected yet in the market when a firm decides to go public initially. Instead, we should wait about a month and see how the market prices the stock. This also reinforces one of his points on the previous slide, which talks about not following the crowd. We should also not rely on publications or quote-unquote expert advice because they sometimes contain errors and almost always contain recycled information. But this does not mean that we should rely on our gut when we make our investment decisions. Instead, we should do our own research. If we are serious about doing our research, then we should personally go to the firm and talk to management and get their insight. We should at least have 50% knowledge of the firm to show that we are prepared and to enable us to ask intelligent questions that would give us the answers to the other 50% of knowledge that we need before we invest. And the final point, before we finish, is that growth stocks are hard to find, and they're not found every day. And sometimes all you need is luck to find a growth stock, but for the most part, according to Philip Fisher, it requires a lot of research and hard work. So this concludes my presentation for common stocks and uncommon profits. Thank you so much for listening.